Hello, and welcome back to the Wall Facer podcast. Today's guest is Seb, co-founder of Steakhouse Financial. Seb, welcome to the show.
Hey, man. Thanks for having me. Excited to be here.
Yeah, I mean, it's kind of the perfect time. We just got to chat a bit in Buenos Aires. I caught that great presentation that you did about kind of becoming a Morpho curator. And I'm really interested to just learn more today about everything that Steakhouse does. I think you guys play increasingly a very important role in crypto, curation, all of these very interesting trends I think are at the forefront of where the industry is going. But before we get into that, I'd love to learn a bit about you. I mean, I first learned of you probably from your blog or from the MakerDAO forums. And I'm curious just how you discovered and wound up working at Maker in the first place. And I think really kind of were a pioneer in RWAs and bringing all of that on chain.
Yeah, sure. I'd love to tell you the little story. So yeah, it was interesting because I started to be involved in crypto, interested in crypto in 2015 with ETH, the beginning, smart contract, others. Excited until 2017. Then there was a ICO mania, the light papers, and I said, well, I don't understand anything. And I kind of left for 3 years. And I was quite busy actually with work. I was consulting for banks, insurance companies, and all those kind of stuff. And by chance, thanks to COVID, in a way, I was between job with my current client, which was a big bank in France. And they had issues renewing the contract because of COVID. And I had some free time, so I ended up on the forum called Sky, or MakerDAO at the time. And I was starting to write stuff because apparently some people were happy to read what I had to write about MakerDAO and how to manage this protocol. And I ended up quite quickly actually to be paid for posting on it on the forum. You were paid at the time to just post stuff. Funnily enough, I made a few $100 for that. And I started to contribute more proactively and created the first core unit at MakerDAO in January 2021, focused on all stuff related to real world asset and financial reporting, which was my background.
Yeah. And even just thinking back to the time, a lot of those RWA deals that you guys were working on were obviously very pioneering in terms of it was really the first time I can think of that people were thinking about how do we connect with banks that are interested in borrowing from MakerDAO on-chain DAOs. What was the first one that you guys actually worked at? I remember Société Générale, Huntington Valley Bank.
New Silver. Was the first one. It was funny because the little story behind all of that was I didn't want to do anything with real world assets. I didn't know anything about real world asset. I didn't and couldn't care less. But I wanted to do financial reporting. And someone at the Maker Foundation told me, well, financial reporting, we don't need you, but we need someone for real world asset. And I said, well, I do real world asset. And it was quite complicated at the time because it was super early. We were not the first, but quite at the beginning. And so the main issue is like, well, you have the smart contract that works well, but then you have the legal aspect. You need to have a MakerDAO lending money to an entity, and MakerDAO is something that doesn't exist. How do you do a paper trail for that? It was a lot of small stories, just finding a law firm to advise for us. Everyone was like, well, but you don't exist. What is MakerDAO? And yeah, it was quite complicated. Now, obviously, it's way easier to do stuff. And that's why now we are doing stuff with Société Générale, with Apollo, Janus Understand, BlackRock. Now it's kind of super easy, but at the time it was quite more challenging.
Yeah, I mean, some of those, well, I guess maybe I'd kind of break it up into two buckets, right? On one end, you have the new silvers, a lot of the things that I think came through the Centrifuge platform, where they're smaller firms that, of course, are maybe willing to go through all of the legwork because they're interested in finding these dollars that otherwise are maybe less accessible to them. Then on the other side, you have the BlackRocks and you have the Janus Hendersons of the world where they do have access to credit. They do have access to dollars in different ways. Is that kind of the right way you think about those two? And in each case, what is it when BlackRock looks at this that they are most interested in? Just another source of capital, or is there something else that they find interesting about working with, say, a DAO?
Yeah, no, you're completely right. If you look back in the days, and I had monthly update for the community, and it was always saying, well, if I could do simply calling a bank to say, oh, I want to buy a few hundred millions of CLOs, that would be way more easier and safer and all that. But there was no way to call a bank and say, well, hello, I'm MakerDAO and let's buy something. Doesn't work like that. And so you need to find people willing to do the legal work, which is costly and complex, to do the smart contract work. Centrifuge was quite ahead of this time on the smart contract stuff. Still for today, it was a bit too advanced for the time, I would say, and dealing with a decentralized organization. I mean, can you imagine having BlackRock coming on the MakerDAO forum and discussing with anonymous people about the safety of investing in a bridal product? I mean, no one. I mean, we spoke with a lot of big banks, with big players, and they were like, there is no way we go public. There is no way we get some people asking random questions. So it was a challenge. So we needed to have some startups that are more willing to do the legwork, to go to a situation where of today you just buy bridal and it's off the shelf, more or less.
Yeah. And I guess I'd love to get your perspective on hindsight, looking back on some of those deals. So I think New Silver, if it's not still going, I am actually not aware, but I think that was kind of successful just in terms of the loans.
Yes, it's still going, and I think it's still
nice. Yeah, all performed pretty well. I'd say some of the other Centrifuge deals like Harbor Trade, Console Freight, I think a lot of those are now kind of in different stages of bankruptcy. And, given MakerDAO's size, that's just sort of a education cost, essentially, to get a lot of these things spun up.
Yeah, correct. More are winding down, and some there are a few defaults that are worked out.
Yes, exactly. Yeah, I guess in hindsight, how do you think about some of those deals? I mean, is that just what it was? It was just kind of an education because you needed willing people that were kind of able to play ball. And of course, they're going to be riskier types of credit, or in hindsight, how do you look back on some of those?
Well, in hindsight, it's always easier. I don't know. I mean, we could probably have done plenty of stuff differently, but I don't know what. And I remember at the time, I was quite clear that we shouldn't make any decision in the team we were managing. We were providing the information for the community to decide. And I remind quite well once calling all the investors, the main investors of Maker, to tell them while we've published this risk assessment, we cannot disclose anything, but we have a feeling that you should vote against. And everyone was like, yeah, no, that's fine. We will vote for it. I was like, well, whatever, do what you want. So it was and it was as well, I mean, some stuff are not working out. It was difficult at the time to know why not. And if they grew, it would have been way better. So it's really difficult to forecast. So it was at the time, it was different. And now obviously we have the more learnings and we don't have to do it anymore anyway, because now we have the Apollo and the BlackRock of the world.
Well, help me understand that. You guys are the ones that have the most insight into these deals. You're suggesting that people don't vote for them, yet people still vote for them. What is the...
Yes, because...
What is the...
I mean, Ryan, you work in crypto as well. So that's just a Wednesday in crypto. Honestly, it was just people who are willing to say, well, we need to do the innovative work. We need to move the space forward. So if we say no to everything, we will never get there. And you need to remember that at the time as well, MakerDAO, the rate was 0%, the risk-free rate. So MakerDAO has a clear issue of making exactly zero revenues and spending on the workforce. So if there wasn't a path to get to a resolution of this problem, MakerDAO would have been dead anyway. So you have to spend a bit of money to get somewhere.
Thinking about some of the other deals as well, the larger ones like the Société Générale and I think Huntington Valley Bank was kind of the other flagship bank deal at the time. What was the outcome of those? I remember Société Générale kind of got off the ground. I think maybe they drew down their first loans and then sort of, repaid them and eventually wound down the facility. What was the experience of working with some of those firms? What worked for them? What didn't work for them? What was the outcome?
No, it was quite interesting in the sense of starting to work with a reputable, regulated institution. So we see the timeline are way different. I think for Société Générale, it took 2 or 3 years to get somewhere. And again, this somewhere, they borrowed 20 million for 2 weeks and I think they paid $100. You can assume that both parties have spent quite a lot on legal fees. So no one made money on this one. But it was a landmark and maybe it was influential for then BlackRock to come and all those institutional actors. There is a big upside for Maker now as well, because now Maker has many billions in those assets, which were impossible at the time and are now possible because of those of this legwork done in the past. For HVB, it's still run. Some of the loans were quite long, so it will take a bit of time to unwind, but I think most of it is unwound. Money is still in transit, but there is a lot of legwork legal work to be done to get something done every time you deal with a real world asset.
Yeah, I guess, and you actually bring up an interesting point there, just all of the legal cost and overhead operational work that goes into some of these deals. I remember sort of when Block Tower ultimately did their large facility. I forget the exact name of it. I remember at the time talking to some people from Maker, and there was maybe a little bit of frustration about the rate that was being charged on that. It felt like it was kind of below market at the time. And just recently, I listened to a podcast that Kevin Meow from Block Tower did, and he said that was kind of like hey, we're gonna do some experiments here. We need a little bit of leeway on the rate to be able to kind of make all of this stuff come together. Has some of the learnings from that ultimately translated into kind of like socialized benefits where other people come in on board now have a more streamlined process? Or I guess one of my questions with sort of RWAs on chain has always been, is there real quantifiable cost savings? Is this actually beneficial, or does actually all of the additional legal overhead negate any of the operational efficiencies? What's the net out on that from your perspective?
That's a very interesting question. And so I would say still currently, most of the stuff done in real world assets is less efficient than doing it the traditional way, because you are taking something, adding a tokenization wrapper, adding a lot of complexity, smart contract risk, and so on for some benefits, but it's still adding cost. So we have an inferior product. But if you look at innovation, it's always the same thing. You have the new technology. At the beginning, it's a bit less performant than the previous one. Then obviously you have a lot of benefits. Composability is one. You have Bridle that is the backing of both Sky and Ethena. Those are ends which are funding now permissionless token, which are more efficient in this way. To your point, there is some discussion about, sometimes the blockchain or tokenization can help on fees, but it's very unclear that it does now, precisely because the scale is still quite small. If you reach to a 1 trillion of asset class, then there will be a lot of optimization, and then it will be way cheaper than TradFi by, I guess, 1 or 2 orders of magnitude. But currently, it's adding cost more than removing cost.
And I think that's always been the challenge when I've thought about some of these and just looked at what actually gets brought on chain. It does feel like unless you're taking a bunch of shortcuts, the operational legal overhead just really negatively impacts the economics of some of these deals otherwise. But I guess a sort of related question to that is also when I look at the RWAs that have been most successful, it is the very fungible, very liquid things. So T-bills, of course, being the number one example. I think some of the things you guys are now doing with Janus Henderson with very fungible like CLO type products, whereas the more one-off type of deals have just been very cumbersome and I think are also very tough for lenders or investors to sort of quantify the risk and behind some of these deals. Do you think that that's an applicable framework? Like the very fungible liquid things work well, but more difficult private credit things still struggle a lot, or would you disagree with that?
So it's interesting because I evolved over time. I mean, you can find me saying, well, I think we should only do public credit because as you said, it's fungible, it's easy, everyone can understand, there is no question. Let's try to put that on chain and do things. That works well, except, well, as you are adding a tokenization layer, there are costs, and then you have an inferior product than TradFi. And then you will come to blockchain and say, well, why are not the institutions coming to invest in Bridle or any money market fund? Well, because they can just buy it off-chain and it will be cheaper. So why would they go on-chain and have all those additional complexities? So then you need to say, well, maybe we should take a space. And this private credit is one where a lot of people are thinking, well, that's the next stage for DeFi. Let's take this complex space that is ripe for this disruption. And maybe as it's not efficient off-chain yet, neither, maybe the blockchain can help because we can be more efficient. And even if the blockchain is not more efficient, the fact that we are just more innovative will make it more valuable.
Okay. I guess I can kind of follow that. And I guess to some extent when you're thinking about, I'm not an expert on Centrifuge's platform, but I think maybe what Centrifuge tried to do well was you're taking a bunch of these kind of individual slivers of different deals, putting them into one sort of aggregate product. And in theory, that could be a more efficient structure than what the off-chain version of this looks like. Is that maybe an example of what you're talking about?
Yes, correct. Now the question is if you want to have those individual loans, well, making them on-chain is quite complicated because they need to be owned by a trust, and then you will have plenty of costs. So it's currently more efficient to tokenize, let's say, GAAA as a fund. The smart contract is just an ERC20 representation. There is no complexity whatsoever. You might ask, well, what's the value of having a blockchain if it's just an ERC20? But still, it's a step toward something more interesting going forward. We need to reach the scale. So if you look at the early Centrifuge model, quite nuanced and quite specific and quite complex, with individual loans making the net asset value. So you could trust the net asset value by the smart contract. And the waterfall was done by the smart contract. So very transparent, very precise. And then wait, there is some specificities. So the waterfall need to change. But on-chain, it's hard-coded like that, so we cannot change it, and then it creates a lot of complexity. So it's really about, let's do some simple stuff first, and let's build and improve over time. Because again, one other thing I learned over the last 5 years is when you want to do something, there is a smart contract that can be complex, legal, obviously that takes a long time. But as just discussing with people to make sure that it's done properly, they understand the nuance of doing it from off-chain versus off-chain. That could take easily 2 years. Just socializing the concept of the blockchain and the value add of the blockchain, composability and all that, that can take 2 years. So things are always moving slower than expected.
Absolutely. Well, I guess also thinking about the value and maybe even kind of taking a very meta step back, right? Why should crypto people, why should on-chain users care about bringing RWA yields and assets on-chain in the first place? And I would say probably my best hunch for this would be, in crypto, we're sort of constrained with our yield sources, right? It is basically borrowed demand, paying lenders, in many cases for some sort of leverage. And I think what T-bills and RWAs tap into are new, significantly larger sources of yield that can fund other interesting experiments. But for that to sort of really take place, these assets need to be interoperable and permissionless or somewhat permissionless. If you think about where a lot of sources of yield come from in crypto today, one, it's over collateralized borrowing, but it's also looping, right? It's people that are looking to lever up their own position several times over. Have you, I guess, one, how have you kind of viewed the adoption of RWAs into some of these more permissionless structures? One, and then two, I guess there's a lot of challenge in that as well as it comes to just the unwinding of some of these. If they're not fully on-chain, it can't be liquidated in the same way that other crypto assets can be. So how have you viewed that so far in that adoption?
One of the big reasons for the money market fund and all those, let's say, safe real-world assets was for almost 2 years, the rate on the lending protocol was below the risk-free rate of TradFi. And you're like, why are people lending at a lower rate than the risk-free rate? While there is obviously risk, smart contract, oracle risk, price gap risk, all those kind of risk. And the main reason is that people see the value of the utility or the convenience of staying on chain. And even for us, I mean, we have a bank account at Steakhouse. I never used it. I want to do everything on chain because it's just more convenient and I can get my keys and I can see what's happening. If it's on the bank, which I don't even remember the name, I don't know what it is. I don't even know how to log. I could probably try and get it, but it will take me some time. While I can go on my Safe app, and I can see all my the assets of the company. So it's way more convenient for me. I can understand that it will be less convenient for other people. So even if it's a less efficient product, or if I have to lose 10 bips, but I can see where my real world assets are on my Safe wallet, that would be valuable for me. So that's for your first question. Then you have obviously the problem of composability and all those things related. For instance, there was a lot of people asking all the time, can we put money market funds as collateral on a lending protocol? And on the paper, it sounds like a good idea because you can say, well, then at least we will have the risk-free rate in DeFi. Sadly, that doesn't work very well because obviously you have the difference in DeFi between the lending and the borrow rate because there is always a liquidity sleeve in all lending protocols. And then you need to have the arbitrager that will make the loop between the collateral and the borrow rate that needs to earn something, otherwise it will not do it. So it's not super efficient in this way. And as you point out, most of those assets are not easily atomic. There is no atomic settlement in the sense you cannot sell them and get the money back in the same block, which for most people in TradFi, they are like, well, you don't need to have the money in the same block. I mean, you can wait 4 hours. I mean, like, no, 4 hours is not the same as the same block because there is a lot of constructs that only work if it's atomic. So some products now are offering those features. So that's great. But it took time to build those products. And obviously the main TradFi product are not offering those features because it's too complex for them. Because there is a lot of friction, they need to change the backend and all those stuff. Yeah, in this way, it's why it's a long process. So we are getting there. And as well as most of the, for instance, there was a lot of yield-bearing stablecoin that was regulated just holding T-bills. Now there is almost all of them are wind down because a lot of people were like, well, it's permissionless securities, so that's risky. They weren't, but that was the view of the people. So it's quite challenging to work, and that's why it's taking way more time than expected to get real world asset adoption.
So if you think about what is the ideal structure for some of these, I think you're right. There was a lot of people that were kind of launching stable coins, T-bills in the back, sort of paying out a yield or something. Those have, I think, mostly kind of wound down or just failed to kind of grow their adoption. What is the right structure here then? Is it some sort of, because I guess one of the big things I think about is you mentioned two things, obviously permissionlessness, but then the liquidity as well, right? So should there be some sort of rethinking of user expectations around the atomicity of liquidity? People sort of, but obviously all of the systems we use in crypto are sort of designed with those expectations. So what is the right trade-off perhaps for users?
So one thing we are missing in real world asset is the creation of secondary liquidity. And it's quite challenging. So for one reason, we started with money market fund, which was a great idea. But for money market funds, there will never be a strong secondary liquidity because no one wants to sell the money market fund at a 1% discount because they can just wait one day and get the full price. And so it doesn't make sense to have a market maker in between or a decentralized exchange in between. Now, for some more complex products, you can see a value or stocks trading on Solana now with the X stocks. But it's still not the same price as traditional venues. So it's more efficient to go off-chain. And who wants to pay 2% slippage when off-chain you are paying 1 bips? It's not efficient. So it's a chicken and egg issue where we need to reach a scale to have all the liquidity. But until we are this scale, we don't have liquidity. So it's difficult to get at this scale. So it's a tricky question that we are working most days of trying to find how we can fix it.
Yeah, you bring up an interesting point with some of the stocks on Solana. Obviously, Bakkt was just acquired by Kraken, who I think is making a big bet on tokenized stocks very generally. Is there a particular pocket of, and again, we say RWAs, it kind of means everything and nothing at the same time, but is there a particular pocket of RWAs that you think maybe people are overlooking at the moment in terms of how adoption is starting to grow, or what are some of the experiments you see out there, whether that you're involved with or not involved with that you think are most exciting?
We have plenty of experiments, some live, some coming, but it's difficult to know which will be the one that will bootstrap a more healthy market or a bigger market. You have the money market funds that are quite liquid on one side. You have the private credit with ACRED or MF1 on the other one side of the spectrum. We are probably missing some stuff in between, like corporate credit. You have now GAAA, which is starting as well. So we need to build all the tools and find how to create an ecosystem to leverage and create more value for those assets on chain.
Yeah, well, it's kind of a perfect segue, I guess, to the topic that's come in from Twitter that most people are interested in. So just for context, today's December 8th, Monday, December 8th. 4 days ago, you guys had posted that the MF1 fund that was allocated through one of your vaults on Morpho recently took a kind of partial write-down in their book of credit. I'd love to actually just take a step back. So for anyone listening who's not familiar with what MF1 is in the first place, what is MF1?
Yeah, sure. So MF1, it's a private credit fund, tokenized private credit fund. It's actually not only private credit, there is also some digital strategies, long short position as well. So it's quite diversified, but the big chunk is private credit. So that's why for simplicity, we say private credit. Why was it something we worked on? For two reasons. One, it's a basket of all the strategies of the issuer, which is called Fazanara, which is a 5 billion asset manager in London. And so it's quite diversified, and it was a good use case to start something more illiquid on Morpho, so on lending protocols, because as it's diversified, the chance of losing a lot of value is reduced. Because if you're allocating 25% to digital strategies, 60% to private credit, which is having sub-bucket as well, and 20% to market neutral, you have a lot of, you don't have too much concentration risk. So that was more or less the idea. Second good point, and that's something you shouldn't forget when you're doing lending against a collateral, you need to have an actual yield that is significant. If you come up with a yield of 7%, well, no one will care because 7% is not much. Currently, it's fine, but 6 months ago, it was way too low because you could borrow at 8-9%. Who is going to borrow at 8-9% to earn 7%? Actually, no one. I mean, no one that is saying. So those two reasons were why it was a good fit. And we also worked a lot with Midas, the tokenizer, to make it a bit more atomic in some ways. You can go in atomically, and you can go out atomically if there is liquidity. For going out, you pay 1% fee. If there is liquidity, there is a 10% liquidity sleeve. If you want to come out any other way, the underlying fund is like most private credit funds, the quarterly redemption. So you can only get out part of it every quarter.
Yes. Yeah. I'm familiar with, Midas has got actually several kind of interesting products on their platform. I think a lot of them kind of look like direct fund exposure to some different things, but also these more private credit type of ones as well. So, again, just sort of recapping the whole situation with MF1. So, correct me please here where I'm wrong, but it sounds like within their credit book, they had exposure to one company, I think it was called First Brands or something, that recently kind of was exposed for some sort of fraudulent accounting activities. And, the majority of that position is sort of being written down to zero or close to zero. What actually has happened kind of in that situation? And then I guess within the overall MF1 portfolio, how have they written that down, and how have you guys sort of thought about what they've written down?
So so just to give you the context, First Brand was one of the big default of this year in private credit. So they didn't have all exposure to First Brand, but as you mentioned, there was some fraud. So they had some invoice that was used as collateral for a loan or sold to change the owner of the invoice. But as they were making double invoicing, obviously the actual guy needed to pay the company will only pay one of the invoice. So that's why there was some fraudulent activities. That's why the exposure was bigger than expected. Still, what we are looking as a lender is how much the fund can lose. From my perspective, that the fact that they had lost 2% or 4%, I couldn't care less. We are exposed because we have 1 million of investment in MF1 at Steakhouse. That's public. We are still making 4% up since we invested 6 months ago, so it's kind of fine. But for the lending part, the question is, can it go down by more than, I think the threshold for us is 6%. If no, that's completely fine. Just like if the price of Bitcoin goes down by 2%, as a lender, I don't care. If the price of Bitcoin goes down by 15% in one block, then we have a loss. Yeah, we have a loss on Morpho or most of the lending protocol. So this is what we are looking for. We are not here to defend the borrowers. We are here to make sure that the lenders don't get hit too much. And that's why actually MF1 is working as expected, in the sense if there is diversification, as it's properly managed, meaning a regulated entity, they need to have some diversification rule and all that. We are not in the situation like Stream Finance. Stream Finance XUSD, so that was the drama of 1 month ago. And that was different. And you can say, well, it was less risky, more transparent. Well, not really, more transparent. But they lost everything because they have a leverage, it wasn't properly managed and all that. So that's the kind of collateral we cannot have as a collateral on the lending protocol because there is a tail risk that is quite high. Tail risk meaning, well, it will not just lose 2% or 5%. It will lose, 15% or 50% or 100%. Those are the stuff we don't like when we are lending. Losing 2% or 4% is completely fine. So that's more or less the idea. And obviously, the fact that it's private credit, the valuation policy, I just saw that we published it. So it's public. I mean, we published the valuation policy. I'm not sure the exact valuation policy paper is public, but you can see that in private credit, you are always marking your net asset value and you are always recognizing losses all at once. Why? Because it's mainly humans. And human people need to get in a meeting. They need to decide what is the discount. So they will do it in one go. There is no linear assessment or market-based assessment in those products. Actually, there is not much market-based valuation on this one.
I've got like 5 different jumping off points from that question. One sort of meta comment is, when you're allocating to something like the Fasanara credit fund, I'm sure you're thinking of, hey, there is going to be some set default rate within this book of credit, as is to be expected. And you have maybe in your mind or even in documents you've shared, I think in the reports you guys put together, some sort of target APY that maybe takes into account what this looks like after some set of kind of expected defaults. So I guess that is kind of number one here. Maybe the second point from what you said is, I do think actually with a lot of these new products coming to crypto, and I think about things like Upshift, I think about things like Midas as well, where there is a risk that these products can be negative. And again, I think to the point earlier of just sort of define our expectations as crypto users, a year ago, 2 years ago, that's not something that lenders in products were expected or accustomed to. And I do think that is a bit of a mindset shift in some of these products as well. I mean, if you look at our site, app.vault.fyi, we report negative APYs quite often on these products because we are just looking at the share price, which for many of these is a manual update from the manager. And it is possible that if you are in these products while they get marked down and you withdraw in that time, you will experience a loss in some of these. So I do think that is kind of a mindset shift.
Hi, this is Ryan, host of the Wallfacer podcast. I want to tell you about our latest product that we think will change how you interact with DeFi. Managing DeFi positions across protocols is complicated. That's why we built vaults.fyi, a single, clean interface for accessing top protocols like Aave, Compound, Morpho, Euler, Lido, and many more across major networks. No wrappers, no extra contracts, just direct access to the best yields with real-time analytics. If you've gotten any value from this podcast, please try it out at vaults.fyi. The link's in the podcast description, and my DMs are open on X and Farcaster. I read every piece of feedback. Now, back to the show.
Yeah, no, I would agree. And in the sense, just to make sure we are aligned, in the vault, in the lending business, we are not investing in MF1. So that's why we don't care about the price of MF1. We are lending against with a haircut or over collateralization. So that's why everyone is like, well, is it a good product? It's not the same for me as a lender. It's not the same way of looking at things that me as an investor. There are some bad products that are completely fine as collateral. There are some very good products as an investment, but very bad as collateral. One good example is stream finance would be probably not, but could be one, or anything that is quite where you have a good upside or a junior tranche. Let's not be too complex, but any instrument where you have a good yield, but you have, for instance, a 5% chance of going to zero. Let's say you find one that has a yield that is a very good investment as an investor. You can say, well, that's perfect for me because you are getting, 15 or 50% APY per year. So that's good. You win. You might try to diversify. So when you take a loss, it's only part of your portfolio. But the issue as a lender is that you are not supposed to take a loss. And so you don't care that the guy investing in the token is making 50% because you are mainly doing, let's say, from 5 to 10%. And when you take the loss, you didn't expect the loss. So what you want to do is to make sure that you are always keeping your principal and having some yield on top of it. While when you're an investor, usually you want to maximize the yield. And if you are doing on leverage, you are completely fine by losing 100% because you put only 10% of the money anyway. So it's mainly the lender that is getting on the hook.
Correct. Yeah, I do think that is a general risk of things like private credit where sort of the upside is like 10 or 12% and the downside is loss of capital. But, obviously it's a very large industry and people understand how to quantify and look through that risk.
That's why we are always looking at stuff that is diversified or asset classes. Asset classes in high yield or private credit, it's quite stable. There would be ups and down, obviously, but some stuff will default, but it's fine because you have a portfolio. And we will have the same issue as an industry when we will want to lend against the stock. I mean, if you lend against, a min-market stock, it can go down by 50%. And so you might have an issue. But if you are lending against the S&P 500, I mean, it's completely fine because having market drops by more than 12% is very uncommon. So if you have a loan to value of maybe 60 or 70%, that's completely fine, which might not be the case for stocks.
Right. Well, and I guess the other big question here, and again, just coming back to this overall theme of sort of the challenges of RWAs is, the reporting timeline of, I guess, and I don't know the answer to this, but like there's maybe 2 or 3 concurrent timelines here. There is when Fasanara understood that there was a problem with First Brands, when they channeled that to you, when they made the appropriate updates on Midas, when that was channeled to the market. And I guess it seemed like there was a pretty big gap between where First Brands sort of fraud was uncovered to 4 days ago when this was made public by you guys. In the middle there, what are all of the steps that's happening, right? Is Fasanara communicating with you? How are they choosing to still make updates up or down at Midas? What does that process look like?
So it's not Fasanara that is making the decision. I mean, they are giving what they call a shallow NAV, or I don't know exactly what's the name, but they need to take the actual people giving the NAV, the reporting NAV, is the fund administrator, which is a third party. And so then there is a discussion between Fasanara and the third party to make sure that, well, what is the actual value? And I mean, let's be honest, there is no actual value because you don't know, and it changes every day and you will not know until the end. So it's more or less guesses. So what was the starting point is that we saw the public announcement of First Brand going to default. So seeing as well Fasanara exposure to 24 million, if I'm correct, around this sort of magnitude. And it's a $5 billion asset manager. So you might say, well, but MF1 is only one part. So what is the exposure? You can make assumptions, looking at the fact sheet to get more information and to cross-referencing. And then there was a new fact sheet that was published a bit later that give us more comfort. And so from the start, we were like, well, using some reasonable assumption, it should be fine. I'm not speaking for the investors. And again, I don't care about the investors here. I'm only caring about the lenders. And then we got a new fact sheet. It was fine. And we were like, most likely there will be a down price, but what is the down price? I don't know. And I'm just making sure that it's below 0% and let's say 4%. If it's in this range, I don't care. It's not a problem for the lenders. It's a problem for the borrowers for sure, but those are not my problems. Then we make sure that there is sufficient liquidity for liquidation. If there is need to be one, there was none. And making sure that those rates are not skyrocketing, which we found some liquidity if we need as well. So if we have all those items, we are like, well, it's a loss for borrowers, but they are speculating in the first place, so it should be good.
Yeah, and 2 other things. One, just to kind of restate, from Steakhouse's perspective, right? You have, a MF1 market on Morpho that you're lending some against. That was within a vault of what size, just for context? Yeah.
The market is 30 million because that's our cap currently, and the vault is 130 million. But I was speaking about the First Brand exposure at the Fasanara level was 24 million for a $5 billion asset manager.
Yes, understood. Yeah, so then I guess really my next question on that, and just kind of coming back to your background here with financial reporting as well, is, if I am looking at that vault on Morpho, I'm looking at a vault, I'm looking at the underlying markets, I'm saying, okay, how do I feel about each of these? Really then, as a lender to that product, if I'm doing deep diligence, yes, I can go and I can read sort of the report that you guys put out on each collateral type. But really what I'd love is some sort of look through into the MF1 product to understand, okay, what is MF1 composed of? And I guess sort of the limitation that we're seeing here is that we're sort of relying on still these very manual processes of they're communicating with their fund admin, who is then making updates on some timetable, whether that's weekly, monthly, quarterly. Is there anything you've seen that's exciting in terms of getting that to a more real-time or sort of streamlined view? Or do the limitations of just, manual processes sort of negate what we can do there?
Yeah, there's a lot of discussion about having more transparency to go in details. But as you pointed out in your question, You started with the assumption, well, yeah, we can read the document, but no one is reading anyway. But we need full transparency to see individual position. So if you are not looking at the document, the aggregated document, are you really looking at the individual position? Most likely not. And even let's say you have Fasna is doing a lot of buy now, pay later. So that's why they have a very small position. You have maybe, I don't know how many, but let's say 1 million people around the world having a credit when they buy a new iPhone. Are you underwrite all those people? No, you cannot. There is no way. I mean, and there is privacy reasons. That's again to my point of if you have an asset class and enough diversification, you don't need to go on the individual exposure. If you have a vehicle that is giving you beta on a private credit asset class, you can see all the research and all the component on the private credit side, but you don't need to know the actual component. Just like when someone, for a very good example is, I guess a lot of listeners are invested in S&P 500 or any stock index. I'm quite sure they did zero underwriting on any of the component of the index, and no one cares. I mean, if they want, they can, but most will not. And it's just like saying, well, the S&P is down by 10%. I don't know why, and I should have had more information. No, if you didn't include the information before, and actually, if you look at our assessment on MF1, which put a document, it wasn't an assessment, it was more a memo, or I don't know how you want to call it. We are saying the valuation policy, there is a 120-day of gap between the moment of the expected default and the time where there is a hit on the net asset value. So you are saying that currently we are a bit less because it was Chapter 11 and all this stuff. But the fact that the drop in price comes way after the default is actually in the document. So it shows that no one read the document in the first place. So it's not so much information. It's just being more confident with the asset class, understanding how it works. Actually, one good insight you can have is when there is high yield, there is high risk. It sounds very simple, but I got the feedback that we have some vaults that are called high yield now. So previously it was smokehouse, and we say, well, smokehouse is a bit too barbecue-ish as a word. So let's call it high yield. It will be easier for people to understand the product. So we have Steakhouse Prime and Steakhouse High Yield. And some people give us the feedback that, well, but it's not very clear that if you are saying high yield, you are saying that might be medium risk. I'm saying, no, if it's high yield, it's high risk. I mean, that's finance 101. If it's high yield, sometimes it's not true. Sometimes it's less risk. But if you don't know, if it's high yield, it's high risk. So again, so that's just simple stuff, I would say. But if you, I'm in this industry for the last 5 years. 90% of crypto Twitter or people, they are just trying to make a point to that they don't care about the actual fact. I mean, the fact that a private credit fund is down by 2%, for instance, no one would care in TradFi. But here we are caring, but it's no one invested in the fund or in the Steakhouse vault. So it's just how DeFi works. It's more narrative based than anything else.
Yeah, I'm sure there are a set of people sort of pressing on this topic that, you know, are not fans of Steakhouse or Morpho. I'm sure that is absolutely the case. I do think at the same time, just to our point earlier, kind of around education, is that, you know, again, the paradigm perhaps that you and I grew up in crypto is more of the Aave compound paradigm, where you are exposed to one product that I would say, maybe they wouldn't say this, but I would say is in no case is supposed to be experienced a sort of bad debt. And there is a reason why they don't accept RWAs, just because of sort of, even the things you mentioned, right? 120-day gap in sort of the valuation policy. So as much as anything, I think you sort of just even explaining some of these details helps people to understand that, okay, like this stuff was communicated to the market, that no one has read the document prior to that moment.
I wouldn't say so. That's also a narrative that real world assets are more risky than other crypto collateral. I wouldn't say that's the case. I mean, for speaking with most of the risk curators or people in the industry, I mean, there are some big collaterals that might be risky, and everyone agrees that, well, it's too big to fail, which is exactly not what we should be saying in the first place. If you look at some crypto collateral like CRV was in a bad spot at some point, was a systemic risk, and it was just safe because all DeFi came and say, well, we cannot let the loan go belly up, so we will buy the CRV at a discount, so it will not blow up. So there was a risk. There was always a risk. Smart contract risk was always there. Oracle risk, big risk that no one is paying attention. So it's not so much that real world asset is more risky. it's more than a real world asset are less close to people. If you remember the Maple V1, there was a lot of real world asset as well. And one thing that worked quite well is lending against market maker. And everyone was like, yeah, we are lending to Wintermute and others. So that's safe because we know market makers are from the crypto industry. And they blew up. And the same stuff on some more exotic for crypto, like, I don't know, pay now, buy later, buy now, pay later, or new silver, never got a default on the Sky side. I mean, there was some default in the portfolio, I'm quite sure of that, but the price was good. So it's not so much that the real world assets are more risky, just they are different and less familiar for crypto audience. But if you look in detail, there is a lot of nuance in both asset classes. And I think it's a combination of asset classes that can provide more diversification and provide a better risk adjusted.
Yeah, I very much agree with that, kind of going back to the original conversation, right? We need these sort of, I think at least, we need these off-chain sources to sort of grow the overall pie, grow the yield that can be distributed to on-chain users. At the same time, yes, some of these just non-atomic, as we've talked about a few times now, challenges with RWAs, I do think introduce these other things. And realistically, anytime something like this happens, we'll probably see the same sort of reaction from crypto users.
And I would completely agree. I mean, for most people and for most of the audience, they should not go in private credit. They should not go in new DeFi project neither. I was always quite clear that I think the prime vault that we are making are for most people. And people using the more high yield one should be a smaller portion of more sophisticated people. That's what we put publicly anyway. So yeah, for sure, you shouldn't overcomplexify. But just if we look at the industry, I remember in 2020 at MakerDAO, there was an outcry because USDC was onboarded. And everyone was looking USDC as super risky and illiquid and plenty of... It was the end of DeFi because it was too risky. Then in 2022, it was T-bills, money market funds. Everyone was like, well, T-bill is not liquid. Only in DeFi, I heard that T-bill is illiquid. And it was, I mean, there was a credit risk. I mean, first time I heard that a T-bill has a credit risk. There is a counterparty risk because there is a custodian and all that, but it was seen as risky. Why was it seen as risky? And not, for instance, lending on AVN compound at the time, because people were used to lend on AVN compound. But money market funds, that was an innovation, and there were securities. So you just need to learn, and that social layer that is taking quite some time to figure out what is risky and what is less risky.
Yeah, interesting point. And I guess, even on the point of T-bills, there are, again, it's just sort of the off-chaining, if that's even a word, of some of this, right? I remember the original manager for MakerDAO's T-bill products. I'm forgetting the name of the group. It's like a Swedish fund.
Monetalis was involved in one.
Monetalis, exactly, right? I think if I remember correctly, just MakerDAO did wind up underperforming significantly on those T-bills, which isn't a risk of like the T-bill itself per se, but again, just of all of this connective tissue between the off-chain structures and being on-chain, fees and, slippage costs and FX. So like, I don't know, those are different, unique kinds of risks, I suppose, as opposed to just say going on compound and lending against wrapped ETH or staked ETH or something like that. Again, so the truth is there's risk everywhere, right?
And it was quite nuanced. And again, there was never a discussion that was nuanced. It was, it's underperforming. But there was never the analysis. And actually, we did the work at Steakhouse to understand why. And yeah, because when you are sending money to Switzerland and using banks, it's quite expensive. There was some that was a longer duration that could make sense, but people sold at the worst time, at the minimum bottom, which is what you can expect, which you shouldn't expect if you are investing in those products. So it's quite complicated. So that's why I think we should move forward more simple stuff and maybe less care about complex. Just like, every day. We are all doing some financial decision and we never go so deep in the financial decision. Why are we trying to go so deep when we are in crypto? Let's keep simple. If it's high yield, maybe it's high risk, so I shouldn't be invested. Or I need to at least understand why I'm invested.
Yeah, absolutely. All right. But let's jump around a little bit more because we've spent so much time talking about this topic now. And I actually feel like we've kind of glossed over this evolution of Steakhouse as a firm from financial reporting, being one of the original core units at MakerDAO, to today, when you are talking to someone for the first time and they ask, what is Steakhouse? How do you guys describe what you do? And then I'd love to also hear about how you got involved in Morpho Curation in the first place.
Yeah, sure. So what we do is we are providing product for the stablecoin economy. So we have three pillars. One, which is still consulting. We started with consulting for DAOs. We are still consulting for a lot of DAOs and companies, financial reporting and all that. Second product is a curation on Morpho and Camino. We are the leading curator on both of those lending protocol, adding new product going forward to help people, to let people having product to generate yield in the stablecoin economy. And the third one is Grove, which is one of the Sky Star or Prime Agent, which is investing part of the balance sheet of Sky as a sub-DAO. So it's a different decentralized organization, which will have a token as well and governance. And working on this area, which is Grove is specialized in all the things related to real world assets.
Excellent. And when we were in Buenos Aires, I caught your presentation about kind of how you became Morpho curators in the first place. I'd love to kind of hear from you, I guess. How did that process begin? And also, I think, what got you excited about? What made you think that you guys could be great curators, as I think you've shown to date?
Yeah, sure. So we were actually advisor to Morpho. So we were involved quite early in the process. And at some point they were like, well, we want a curation business or creation product. So we need curators. And do you want to be one? And we were like, well, I don't know. And we figured out it was it was super interesting for the last almost 2 years now. Yeah, 2 years to learn and to see the space evolve. And one of the key important stuff that we kind of like at Morpho was the code base was simple, immutable, but quite composable. So it's quite simple. If you look at it, it's 2,000 lines of code if you put the Morpho and the Metamorpho layer, but you can build a lot of feature on top of it. And now we are working on the code base of the backend, optimizing markets, making all those allocation fully automated, and seeing the evolution of the market is quite interesting because the difference is that Morpho is open for any curator. So it's not because you are the biggest one curator on Morpho that you can decide what the market will do. Anyone is deciding collectively what the market will do, and sometimes you need to.
Yeah, well, that's a great question in and of itself. I think, if I were to rewind the clock 3 months, I would say, okay, there are two, curators at the top of Morpho, you guys and Gauntlet. And then there's sort of I don't know what the word would be, like middle class of curators, right? I think a lot of folks that were smaller than you guys, but still were delivering good yields. In many cases, yields kind of above where you guys were, just perhaps as a result of higher risk, as we've talked about. And then I think everything happened with Stream and Elixir. And it feels now like curation is you guys, Gauntlet, and other smaller curators. I think some of the middle class maybe feels like it's been wiped out a bit. I'm curious from your perspective, looking ahead, what do you think the curation market is going to look like on these different protocols, whether Morpho, Euler, Silo, Camino, other places that have curation as well? Do you think it will be sort of a barbell effect where there's one or two big curators and then a bunch of small ones, trying to sort of try out maybe risk strategies? Do you think we'll see more TradFi players come in and begin curating markets? Like, how are you thinking about the evolution of where that market is going to go?
Yeah, I think first it's still quite small. If you think about just the number, I think the TVL of Morpho is 10 billion around this number. So it's not that much to sustain 100 curators, but we saw some curators going down a bit because they were more exposed to the high yield part. But obviously they were providing a value for some lenders because some lenders invested in their products. They wanted something that, for instance, at Steakhouse, we are not offering. We are always saying, well, even with high yield, I'm not going too far on the risk side because, well, it's not what we do at Steakhouse. So we have a high yield product that we didn't have at the beginning, but we always try to get it to understand what we are doing. And that takes a lot of time, and we cannot invest that much that we can underwrite all the tokens. And it's clear from the history that maybe some weren't quite underwritten by the competition. But still, I think there is a value for having a lot of curators because that's make an honest market. Obviously, the fact that we have competition, anytime someone can come up and grow quite fast, and we saw it in the past. sometimes because they did something good on the product side, having collateral that was actually quite sound that we didn't see, having a good distribution strategy, which is quite key as well in those products. So I think there is place for a lot of, and some niche activity as well. We are not offering everything. So it's good that other people are making a business at offering stuff that we are not willing or interested to offer. So I think there will be a few big players, more generalist, and a few players and a lot of players that are smaller, but more niche and providing products that are more bespoke. So I'm quite convinced of that. And yeah, I think there is a lot of opportunity for a lot of people. I honestly love the curation business because it's actually quite competitive and there is always something to learn every day.
Yeah, and I am actually curious. And so how big is the total team at Steakhouse today? Maybe specific, and also the people working on the curation business.
Yeah, Steakhouse as a whole is 24 people. And on the curation side, we are probably, let's say 12.
Cool. Yeah. So I'm curious actually the kind of day to day, like where you're spending most of your time there. Are you spending a lot of time looking at evaluating new collateral types? Is it on the sort of lender side of the equation? What does the day to day of Seb look like?
No, it's mainly on the client facing. So it's mainly partnership. Actually, we don't sell the product to retail, obviously, but we have partnerships, for instance, with the Coinbase. This one is public. We have plenty that will come in the following weeks or months to have some bespoke product for fintechs in the wide acceptance of the world. We have some part of the team that is looking at onboarding new collateral. But again, as our focus is more on making good product more on the governance side. For instance, one thing that is we are spending quite a lot of time that I'm not sure it's that important for users because we don't get this request quite a lot is all our products are non-custodial in the sense when you invest in a Morpho vault, that is from Steakhouse, you can use your receipt token of the stake USDC that you get by depositing, and you can go on the Aragon DAO to vote and make a veto against the decision. So we cannot add a new collateral, for instance, a new collateral type on a vault without having used the opportunity of putting a veto. So anyone can put a veto and you only need one person on most vault to put a veto. So this is something we spend quite some time. Currently for Morpho Vault V2, we spend quite some time to iterate on this design where now the investors in the vault or the users of the vault are also co-owner of the vault. So in the sense that are having all the control of the vault to make sure that the curation business is non-custodial, which is quite key for us.
Yeah, I actually only learned about that when I caught your presentation in Buenos Aires. But, I actually just out of curiosity, in practice, have lenders ever actually vetoed new collateral types, or does it go back to your earlier point that most people just kind of give the thumbs up?
Yeah, correct. I mean, first, maybe it's because we never tried to add bad collateral. So maybe that was the reason. But I'm not going to try to add a fake collateral, even just to see if people are replying, because that will not be a sound PR move. I'm quite sure it would be a bad idea. So we will not know. We have some key user of the vault where we have a Slack channels and they have notification. So for those, we have a more white glove. So we are always speaking with them and keeping them up to date to any new collaterals that we are adding. So they don't have to make a veto because we speak with them.
Makes sense. Well, I'd like to just, as we're coming to the close here, transition and learn a little bit more about what you guys are doing with Grove today. But before that, I have another question that I've discussed with a few people recently, and I think you're probably a great person to ask, which is, as we look at the curation model and sort of the businesses like Steakhouse that have been able to grow, I think the last reported number from a Morpho blog at least was you guys are doing at least $500,000 in annual revenue from fees on vaults. I'm sure that's much higher today as that was a few months ago. You guys have obviously been able to build a great business on top of Morpho. It's continuing to grow. It's very clear how that happens. How do you view Morpho's token accruing value in the future? How do you think about that sort of split today?
Yeah, I think more like Uniswap, there is a fee switch that's a Morpho governance can activate anytime. I don't know much about Uniswap, but I think the view of the community, and I haven't we have some Morpho token, but I'm not super familiar with the governance of Morpho. I guess the idea, same idea we have for Steakhouse. The goal number one should be to grow to be big, create the brand, create more assets. And that will be the key starting point. Monetization should probably come later anyway, because it doesn't make much sense to turn on the fee switch when you don't have the network effect already in place. But now we see that Coinbase is integrated directly on Morpho. If you have all the fintechs, all the exchanges, all the TradFi institution using Morpho as a base layer, then it will be a good time to switch 5 bips of fees or whatever the community might have in mind.
Makes sense. As we're coming up to a close, I'd love to talk about really the third pillar of your business, which is now growth. My understanding is that you guys had $1 billion credit line for Maker. You're allocating that then to Janus Henderson today through their CLO product. And your goal is really just to make a return over what you're borrowing from at Maker. Would you speak about it differently?
Yeah, just to come back, Sky, and it was MakerDAO before. The issue is that it's DAO organized, so it's quite complicated to have a complex decision. There is only so much bandwidth that the governance can have. So the idea was to put Sky on top, ossify it as much as possible, make small decisions, and delegate the allocation decision, but also new product creation to sub-DAOs, or now they are prime agent. And growth is one, there is Spark and a few others that are coming down the pipe. And I think the idea is to decentralize a decentralized organization. So that's a meta decentralization, if you want, to be more efficient. And so, yes, it's allocating part of the credit line of Sky, obviously trying to get a better yield than what they are borrowing at, but also creating a new set of products that will, at the end, boost the utility of USDS as a token.
Yes, makes sense. And I guess in many ways, this is sort of just the natural evolution or spin out of some of the very early work that you were doing at Maker in the first place. But now I think with a bit more kind of free reign, and you'll have your own DAO, I suppose, for Grove, but escaping the overall bureaucracy, perhaps of the Maker, now Sky processes. One question I've had as I've looked at a few of the stars is, let's say we go back to an environment where crypto lending is poor, right? There's not a lot of on-chain borrowing activity. Something like what you're doing at Grove, I'm sure will be, hugely beneficial to Maker. In that model, do you, as Grove, get more kind of capital allocated to you and others taken away from sort of the crypto-focused stars? And I suppose vice versa as well, right? If crypto rates become great again, we're back in a high leverage cycle. RWAs, are they less appealing? Like how is Maker, and maybe I should ask Rune, kind of viewing some of these trade-offs between these different stars?
Yeah, I guess there is some specialization of the stars currently, but I'm not sure the end model will be to stay specialized. For instance, Grove being allocating onto real world assets. That's not the idea. The idea is to have different entities allocating, just like a fund of fund, if that make sense. It's a bit different, but the idea is to have a diversification of stars that we allocate a bit differently. So on average, it will be more efficient because they will have more autonomy. There will be a bit maybe more risk, but there is capital at the star level to make sure that there is no issue neither at the Sky level. So the idea is to be able to move faster by having many stars. Now, obviously, the question is specialization of each stars or just competition? Because if there is one trade that is good for everyone, why would anyone do something else? For instance, if it's GAAA is the best product, everyone wants to invest in GAAA. So, but if you have 10 stars that are all invested in GAAA, what's the value of having many stars? So that's a trade-off that the Sky governance will have to decide. And I'm quite sure there will be a lot of learnings going forward.
Yeah, it's actually something I'd like to cover on some future episodes, I think. One, the Sky ecosystem, MakerDAO previously, has always been confusing. I think now with sort of Sky and the stars, new governance, all of these sort of different models, I think there's actually a great, there's a lot of interesting things I think to kind of dig into, even about some of the value capture here. I'd always viewed sort of the Sky transition as almost like Maker always felt like an asset that had many things underneath the hood and was never properly valued. And perhaps this sort of Sky model is almost like some sort of a sum of parts analysis, where you can say Spark is worth this and Grove will be worth this. Sky still holds the token of all of these things, so maybe it should be worth more. I don't think we've fully seen that come to realization yet, but I am very curious about that kind of going forward as well.
No, I fully agree. I mean, what I see is that there is more innovation, more dynamism, because again, there is more autonomy at the star level. And so overall, it might bring the whole ecosystem faster to growth.
Well, Seb, thank you for all of the time today. as a closing question, I think we've done a great job already kind of digging into everything you've seen with RWAs, where you see a lot of that going. And we learned a lot about Steakhouse, learned about how you think about some of the ongoing current events, and then, of course, everything with Grove as well. But I guess looking ahead for the next few years, how do you see Steakhouse evolving? Is it doing a lot of what you're doing today, but at a bigger scale and much better? Are there other things we should be on the lookout for coming from Steakhouse? Yeah, give us a little bit of insight.
Yeah, sure. So on the Curation side, we are currently doing only lending, I think. So repo market, what we call repo, when we lend against a collateral with a haircut. I think that's a good primitive, but now we will add soon term lending. So with Morpho Market V2, that will be term lending. I think Camino will have something as well along those lines. So that will be super interesting because it will be the creation of the yield curve. So we might see, well, we are able to borrow at 5% today. But if you want to borrow for 3 months, will it be 4%, 5%, 6%, 7%? Who knows? So as an ecosystem, we will have to figure those issues down the line. I'm conscious there will still be a lot of real world assets. As I said at the beginning, real world asset is what I do for the last 5 years, but that's not what I wanted to do at the beginning. I guess I will never be able to stop doing it. But what I really like is creating a new financial ecosystem on chain. And real world assets are one part, it's one component. But what is very interesting is to recreate all the yield curve, the DEXs, making sure that everything is flowing nicely. And yeah, that's something that will take at least 10 years. But I think in 10 years, the space will be way bigger and we will do at Steakhouse plenty of innovation. And if we can be the ones that are driving some innovations, that will be great going forward.
Excellent. All right. Well, I'll include all of the links to your Twitter, Steakhouse Twitter, all of that in the show notes. But once again, thanks for the time and thanks to everybody for listening.
Thanks, Ryan.
Bye.